For years, capital allocation decisions often happened in the background. As long as revenue was growing and markets were rising, investors were relatively forgiving. Companies could pursue aggressive expansion, large acquisitions, ambitious research projects, and share buybacks all at once. But today, that tolerance has narrowed dramatically. Capital allocation is under more scrutiny than ever. This shift reflects a deeper change in the economic environment. Interest rates are higher than they were for much of the past decade. Financing costs are no longer negligible. Investors are more selective. Growth is less predictable. In this climate, every dollar deployed carries greater weight. The question is no longer simply whether a company can grow, but whether it is using its capital wisely. One of the biggest reasons capital allocation is facing greater scrutiny is the cost of money itself. When borrowing was cheap and abundant, companies could afford to experiment. They could fund long-term projects with uncertain payoffs. They could absorb setbacks more easily. Now, higher interest rates increase the hurdle rate for investments. Projects must demonstrate clearer returns. The margin for error is smaller. Investors are also demanding stronger return on invested capital. Instead of focusing solely on revenue growth, markets are emphasizing profitability, free cash flow, and balance sheet strength. Companies that generate stable cash flow and allocate it efficiently are being rewarded. Those that pursue expansion without clear returns often face skepticism. Another driver is volatility. Demand patterns have become less predictable. Consumer behavior can shift quickly. Enterprise budgets fluctuate. In uncertain conditions, aggressive capital deployment can look risky. If revenue projections miss expectations, heavily funded projects can strain financial stability. That risk has made boards and shareholders more cautious. As a result, capital allocation discussions have become more disciplined. Leadership teams are stress-testing investments under conservative scenarios. They are phasing projects rather than committing all funds up front. They are setting stricter performance benchmarks before releasing additional capital. The sequencing of investment has become as important as the investment itself. Mergers and acquisitions are a clear example. In previous cycles, strategic acquisitions were often celebrated for expanding scale. Today, integration risk, financing costs, and cultural alignment are examined more closely. Investors want to understand not just the strategic rationale, but the return timeline and downside exposure. Shareholder returns are also under review. Decisions around dividends and share buybacks are being evaluated alongside growth investments. Companies must balance rewarding shareholders today with preserving flexibility for tomorrow. Overcommitting to buybacks in uncertain markets can limit liquidity when conditions tighten. Operational efficiency plays a role in this scrutiny. Businesses are expected to optimize existing assets before pursuing large expansions. If internal inefficiencies remain unresolved, deploying additional capital can amplify structural weaknesses. Investors increasingly ask whether management has maximized what it already owns. Technology spending has come under similar evaluation. While digital transformation and AI initiatives are important, companies are being pressed to demonstrate measurable outcomes. Broad declarations of innovation are not enough. Clear performance improvements and cost savings must justify expenditures. There is also a governance dimension. Boards of directors are more engaged in capital allocation decisions. Risk committees are evaluating exposure under various economic scenarios. Transparency around decision-making has increased. Shareholders expect detailed communication about how capital is being prioritized. The market's reaction patterns reinforce this environment. Companies that miss earnings due to poor investment timing often face sharp valuation declines. Conversely, firms that demonstrate disciplined allocation, even if growth is modest, tend to receive stronger support. Predictability and prudence are commanding premiums. Another factor is leverage. With debt costs elevated, balance sheet management has become central to strategy. Refinancing risk is visible. Maturity schedules are closely watched. Companies are carefully weighing whether to reduce debt, invest in operations, or return capital to shareholders. Each choice carries trade-offs. Global uncertainty amplifies these pressures. Geopolitical tensions can disrupt supply chains. Regulatory changes can alter industry economics. Currency fluctuations impact international operations. Under these conditions, capital tied up in inflexible projects can become a burden. Flexibility has become a strategic asset. Capital allocation is also linked to credibility. Leadership teams that consistently deploy resources effectively build trust. Those that pursue large initiatives without delivering returns risk damaging long-term confidence. In volatile markets, credibility can influence valuation as much as performance. Importantly, scrutiny does not mean paralysis. Companies still need to invest to remain competitive. Research and development, infrastructure upgrades, and strategic acquisitions remain essential. But investments must now clear higher thresholds. They must align with long-term strategy and withstand conservative stress tests. Why capital allocation is under more scrutiny than ever comes down to one core reality: uncertainty magnifies consequences. When the external environment is unstable, internal discipline becomes critical. Poor allocation decisions are punished quickly. Effective allocation decisions are rewarded. In previous eras, momentum could mask inefficiency. Today, inefficiency is exposed more quickly. Capital must work harder. It must generate returns that justify its cost. It must strengthen resilience rather than weaken it. Businesses that thrive in this environment often share a common characteristic. They treat capital as scarce even when they have plenty of it. They evaluate opportunity costs rigorously. They prioritize durability. They balance growth ambitions with financial control. The heightened scrutiny around capital allocation is not temporary. It reflects a structural shift toward accountability and precision. In a market where volatility is constant and capital is more expensive, disciplined allocation is no longer optional. It is a defining measure of leadership. And in today's business landscape, how a company deploys its capital may matter more than how fast it grows.